Most people use life insurance wrong and it kills their growth. But here's how you can actually do it the right way, just like the wealthy do. All right, so let me explain, because not all life insurance is the same. You buy term life insurance, it's death insurance. That's it. You have to die for somebody else to get paid. But when it comes to life insurance, specifically like whole life insurance, now there is universal life, that's a whole nother topic, and that one's not what we're talking about here, because that one's not as guaranteed as people think. But with whole life insurance, this is something that the wealthy have been using for generations to make it work in their favor. And this is what they do. Understand that whole life insurance does have a death benefit, but it also has this tax-free savings account inside of it. So when you're paying it, yes, it's more expensive than term, but more of that money is going to build up your cash. Now here's the mistake that most people make that makes them go broke. Is that you've probably been taught by an insurance agent at some point in time, if you've ever been around long enough to get sold by one, they're going to tell you, hey, you can use this life insurance as a supplemental retirement plan. And so they'll teach you, hey, if you just put money in this, and it's going to take a long time to even build up any significant cash, but if you put money into this for decades, then you can eventually pull out tax-free income. Now, although that's true, the biggest thing they're missing is it's not really creating wealth for you. The proven way to do this, and independent studies have been done on this to prove so, is that the best combination to do in your life is not 100% in the stock market, it's not even 100% using whole life or annuities. It's actually, of all those options they were looking at, it's the blend of using whole life plus growth investments. Those two hand in hand gives you more money now, and it leaves a legacy behind later too. And so this is what the wealthy have done for so many generations. They've already figured it out, but unfortunately most Americans are taught by salespeople in suits called financial advisors or other experts that are also working for those financial companies trying to pitch you their agenda that makes them money, not necessarily you. And so this is what happens, that many people don't realize that you can actually access that cash now. Now they're always told you can set it in there and forget about it for many, many years, but it just doesn't work. The thing is, with whole life insurance, you can actually borrow the cash. Now you might be asking, why would I borrow my own money? That doesn't make sense. And the answer is, you don't. You don't borrow your own money. You borrow the money from the insurance company or even a bank that gives you a line of credit against the tax-free savings account that's in there. They don't give you a loan based on the death benefit. It's that tax-free savings account. And they'll lend you that money. The great thing is this, is that you can pay it back however, whenever you want. The deadline for paying it back is your death. There's no minimum monthly payments or things like that. Now they do charge you interest. This is the lie that you're taught by some of these infinite bankers out there, is they'll tell you, hey, you just pay yourself back interest. That's not true. They do charge you interest, whether it be the insurance company or the bank, they charge you interest. But this is the cooler part, is that they're also, the insurance company's paying you interest on all your money. So say for example, you have $100,000 sitting in there right now, you want to borrow $50,000. Now you can withdraw $50,000 from your life insurance policy. That is correct. You can do that and not have to worry about any interest. But here's the reason why the wealthy don't do it that way. Because they know that if they borrow from the insurance company instead, see, if I pull out the $50,000 for my own money, now I have $50,000 less, but I'm also not earning money. I'm not earning any interest on that $50,000. But if I borrow money from the insurance company, my full $100,000 is in there earning tax-free compounding interest. Right now paying about 6% a year, tax-free. Guys, when you factor in the tax benefits compared to people doing IRAs, that's actually just about as well as what you could get with the stock market, arguably, right? I know somebody's going to try to argue that, but again, depending on the market and what it's doing at that time, you could actually be getting similar returns when you factor in that you get to keep your money because there's no taxes being taken out. Now, they'll borrow that money, of course, because that money's still in there growing and compounding. Now, they're going to use it instead of just using it for buying cars, right? Like a lot of people will talk about that in the infinite banking space. You could buy cars with this or buy your own house. I don't recommend that. I love leveraging the bank, especially when the interest is lower. And so this is something that we teach. And I know a lot of wealthy people do the same thing. If they can get cheaper interest in the bank, they'll leverage the bank all day long because it's their money they're using, not against any of ours, to go leverage against assets, right? But for money that the banks won't give us, then we can use the money from our policy to use that to create more cash flow. And that's the key trick here, is that the wealthy use this to create and generate real returns with their money. So for example, let's just say you're a business owner and you say, you know what, I need some extra capital right now. I don't want to have to use a high interest credit card, but I do want to see if I can use the money that's sitting here in my savings within my life insurance policy. So you go and you borrow it. And again, there's no credit check. You don't have to have perfect credit or anything. They give you a private loan. And like I said, you pay back however, whenever you want. This is better than a credit card because a credit card, you have to start paying back on it. Well, if you're using it for a strategy in your business that doesn't cash flow immediately, you're having to pay for something you're not getting a benefit for. Here, yes, they charge you interest, but you're not required to make any payments. So you borrow that money. Say you borrow that $50,000, it goes into a project, and your hope is that it's going to generate $5,000 to $10,000 more a month in your business. Well, now what happens is as you can start to eventually make that $5,000 or $10,000 a month, use that money to pay back towards your loan. So what it does is it pays down your loan, causing less and less interest to be charged to you, while they're still compounding more and more interest over time. And so what you do is you create a spread. They start charging you less in interest than you make here, and you're making money in your business too. You're making money right now. And that is the key. Wealthy people figure out, how do I create wealth right now? How do I get my money to work harder for me right now? So they do that. So in a business, it's a great thing. Oh, and by the way, the interest you do pay, it's a write-off on your taxes. So really you get like a triple dip of benefit. You not only just make money in two places at once, but you get a tax advantage too. Now, what if you use it for real estate? What if you use it for something to create cash flow? We get a lot of our clients that are investing in different things, even if they loan money to real estate investors, making 10 to 12% a year. Well, great example. They can actually take that cash flow, use it to pay it back towards it, to pay down a line of credit, and as they pay it back, guess what? It frees up the cash, then use again and do it again. This is why it's called infinite banking, because as you pay it back towards it, it frees up the cash, then use again and invest again, and you keep cycling the money through, picking up more extra dollars along the way, making more money than you would just using a simple crappy bank savings account. Because again, the wealthy don't like using just simple bank savings accounts. They love leverage, and that's exactly what this gives you. And here's the best part. We keep referring to wealthy people using it all the time, but you don't have to be wealthy to do this. If you have at least $5,000 a year that you're able to save, that's a year, not a month, but a year that you're able to save, this is something that could be a very good option for you. So if you want to figure out how to do that, go to moneyripples.com/infinite-banking to book a call to see what that would look like in your situation today.